Today we are going to discuss about the types of investments. So you have many types of investments, but the investments can be broadly classified into two categories. So when you want to start your financial journey, and when you ask your financial advisor, when you ask your friends that you want to invest, you will be given two options. Either you can invest in equity or you can invest in debt. Now to a layman, the person gets confused, like what is equity and what is debt. Therefore, equity and debt are the two components of investments. Equity investments are market-linked investments in which the returns are not guaranteed. Whereas debt investments are investments where the returns are guaranteed. In other words, you know what you're going to get at the end of XYZ period. The examples of equity investments will be stock market, mutual funds, commodity markets, whereas examples of debt investments will be savings account, recurring deposit, fixed deposits, public provident fund, senior citizen savings scheme, and so forth. Therefore, you should know how much you need to invest in debt and you should know how much you need to invest in equity. The question arises as to how much should you invest in equity and how much should you invest in debt? What is the right mix? Now, you know equity is high risk, high returns, low risk, low returns, medium risk, medium returns, because it is purely linked to the market. The best formula or the best rule in investing, which is also a thumb rule for many financial organizations, is your age is your debt percentage. That means if your age is 25, the amount of savings you should have in debt is 25%. Remaining 75 has to be in equity. Therefore, consider one more example where your age is 40. When you're of age 40, 40% of your investments have to be fixed, which is your debt, and 60% has to be in equity. That is the reason people say if you start young, you can get the benefit of equity markets, because the older you grow, your risk appetite has to come down because you have to increase your financial cushion. Therefore, the earlier you start, the percentage you can invest in the equity market increases. So I hope this clarifies how much you should invest in equity and debt. That is the reason now you look back at your investments, think how much percent you have allocated to equity and debt. And if your investments do not match the thumb rule of age equal to your debt percentage, you will need to rejig your portfolio. Hopefully this helps. Thank you.